Hello and welcome to another edition of the Moving Iron Podcast. This podcast is proudly provided by Axon, helping dealers move more iron for almost 100 years. Find out more at axontire.com. Axon was started almost 100 years ago out of a passion for keeping agriculture moving. It's that same passion that drives them today. With a vision for a better experience for both farmer and dealer, they set out to create a better way to move more iron. When you partner with Axon, you get immediate access to a full range of products and solutions designed to meet the complex needs of today's grower. Axon carries all major brands and sizes of tires, wheels, and tracks. From custom colors and sizes to fully customized wheels, you can have the solution for virtually any problem today's farmer is trying to solve. To find more or become an Axon dealer, please visit axontire.com.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast. Markets with Shawn Hackett. This edition of the Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years. For more information, go to axontire.com. Also, if you're looking for a great place to help your salespeople sell more stuff and manage their client base, as well as process their deals faster, check out Arrow at heyarrow.com. Shawn is with Hackett Financial out of Boca Raton, Florida, and Shawn is nice enough to come on a couple times a week to talk about what's going on in the marketplace. So, Shawn, we had our first big blast of cold weather. We've had some cold weather, but not this cold. We had yesterday morning when I was going into work, it was 10 degrees. So you're not that it's unnormal to have 10 degrees like that, but the erraticness of the weather that you've been talking about is here, because today's high is 64. So it went from a low of 10, high of 28 or 30, and now we're going to be 64, and going into the weekend here. So looks like that erraticness that you've been talking about is kind of on its way.
Yeah, and that thrashing of weather volatility, of temperatures, is going to continue through the end of the month. Remember, we had this sudden stratospheric warming event that just, it totally stirred up the atmosphere. So the atmosphere is doing this right now, and you're getting this erratic behavior, big shifts of cold, of warm, of historic storms hitting the Northwest. Some of the worst flooding they've ever seen there. So it's part of the transition away from the weather pattern that we had in October, which was super warm, to the pattern we're going to establish here in early December, which is a more persistent cold winter pattern. And we're still in the throes of this back and forth action. And so this is going to be so. For an example, here in Florida, I'm sure no sympathy from anyone on your show, but we did get down like in the upper 50s a few days ago.
Man, that's great.
Today it's going to be in the 80s. Yeah. Now, next Thursday, Wednesday, Thursday of next week, we're actually going to be in the upper 30s here in Florida. So once again, these big undulating thrashing about is part of the transition to the cold winter pattern. And so that is a symptom and a function of this process, but ultimately, Casey, it's going to resolve itself to a persistent cold winter pattern that we've been talking about.
Yep.
So,
all right, that is going to have its time here, and I think it's going to be just looking out here. I can start seeing those patterns starting to already kind of come together as you look at the long-term forecasts and those kind of things. So, let's jump over and talk about cotton a little bit here. What's going on there? Cotton has got, it's still up there, man. It's still, like right now I'm looking at it, it's trading at $1.17 right now. It opened at $1.18, so we're off a penny. But, man, it is still just up there high. So talk about what's going on in cotton, man.
well, the Chinese brought it up here by buying everything they could, and now the market is trying to determine, have we done enough to factor that in? And at this price level, Casey, we're going to hurt demand. We're going to hurt cotton demand. There's no way global cotton demand is going to, absent Chinese demand,
right,
actual consumer demand is going to hold up. It's not. So what the market's trying to do is say, okay, China, you want to come in here and buy all this cotton, and we have to ration the end user demand down to compensate for the fact that you're taking all this cotton from us. And I think the market has done that, Casey. I think this 115, 120 area. I think it's at the right, unless something new comes along, I think that's a price level that will ration enough demand to put some bales back into the ending stocks globally and account for this crazy buying that we've seen from the Chinese. So, like I said, right now, I think the market has done and is doing what it needs to do. And I don't know any cotton farmer around that's not going to be planting more cotton if they can get away with it at these price levels. They're
Absolutely,
they're going to do it, and that's a bearish factor as we move into the spring planting season. So,
there's one of these that I've been watching a little bit, and you and I have talked about it just a little bit. We haven't really spent much time on it, but lumber. You look at lumber right now, and it's down significantly from what it was 3 or 4 months ago. I mean, 3 or 4 months ago it was over $1,000 a linear foot. Now you're looking at $757. It's been kind of hanging out there, right? It's not really gone anywhere, not really done anything. And you look at the reports where housing starts are down a little bit because more people are spending money on buying remodeling a home or something like that. And I guess talk about lumber a little bit and what you see there.
You have to remember we had this whole tariff dispute with Canada that initially got this bull market going several years ago. Mm-hmm. And then we went into the virus where every lumber mill shut down and all the inventory was depleted. And then the housing market went crazy once we reopened. And everybody says, I need lumber right now. And everyone says, well, we don't have it. And by the way, we're not going to get our lumber mill going for 6 months or so at least. And even then, probably not up to maximum capacity because hiring people, everyone's, the new rules. And so we had this crazy bubble. I think it went to 1,600, 18, whatever. I forgot the exact number. It was a crazy bubble. Yep. And finally, everybody opened up, maximized, lumber output. We were importing lumber from everybody who was willing to sell it to us. And we finally got ourselves an oversupply. And remember, the average cost of a house, I believe, the average cost of a house was up $65,000 in 1 year because of the cost of lumber. What happened? People just say, I'm canceling, I'm not building, I'm walking away. So you got a demand response. So the market crashed down to like 500-ish. It's kind of been bouncing around between 500, 700, kind of consolidating this boom bust cycle that we're in. And I really don't see that trading range changing. I think we're going to have a long, cold winter. That means that the typical construction you would see in the spring is going to be delayed further into the late spring, early summer. And I think the housing market's peaking out. I mean, we had just this massive response to the virus and people wanting to stay home and speculators buying into the market. Now, of course, production's growing like crazy. So I just think if you look at the lumber market, that could be a high, Casey. We may not see again for a very, very long time. I mean, like that could be one of these decade tops, 20-year tops that you look back and say, and we still haven't got back to that $1,800 level, And I think that high was one of those kind of highs that you may not see again in a very, very long period of time. So I think it's a trading range market, really. If you're a buyer of lumber, you buy the lower end of the trading range. If you're a seller of lumber, you sell the upper end of the trading range. I just think that's the kind of market, not a trendless market, but a $200 swing each way.
Mm-hmm. Yep. All right. So the other one I've been watching here close, just because of what's been out there, is milk. And now milk's been trading around. If you watch where it's been trading at, between the mid $18 range to the upper $17 range, and it's been, one day it'll run up, next day it'll just take it all back. It's just been a very volatile market. What's causing all that volatility in the milk market right now?
Well, we had to crash after the government stopped buying the food box program, and we had this crash, and it just crushed production everywhere. And so now our production is now negative. The U.S. production is negative. We're having negative production year over year, but the market's already rallied. Started rallying about a month and a half ago on the idea that we eventually got this thing going. Now we're hearing about this proliferation of the virus in Europe, and now we're seeing more partial lockdowns and so and Europe is a huge buyer and consumer of dairy products. Huge. And so, now there's concerns coming back in that maybe the demand surge that we had after we reopened, we may take a back seat. So the days that the market's looking around and saying, maybe, are we going to be dumping milk on the ground again? I'm just throwing out, you get these big sell-offs, but then you say, okay, well, but things are still better than they were. So you're getting some of this thrashing back and forth. And remember, the Chinese still have a pretty serious milk shortage. Their milk prices domestically in China are near the 2014 highs, and they've been buying a lot of milk powder on the GDT cash market exchange, which is a global exchange that trades every 2 weeks. The problem is they typically binge buy in the fourth quarter, and then they walk away. So the market's getting worried that we might be ending their buying spree, and what happens afterwards. And so there's a seasonal tendency for the market to top out here, in November and then fall down into the first quarter before, riding itself into the spring. And it looks to me like we've already begun the downside pattern in class trade. It looks like class 4 prices, which is the milk powder portion, might have rolled over in the last couple of days. So we're kind of bearish the milk market, Casey, into the first quarter. We turned bearish about a month and a half ago in our dairy report to our subscribers. And, we would just be careful. If you haven't hedged or you haven't done as much as you should, I'd just be a little careful to protecting first quarter price. Things could, the milk market loves to overshoot to the downside. It's just the nature of that market because it's outside of powder. It's not really a storable market. It's more of a fresh market that's got to go to the market when it's ready.
Yep. All right. Rice is something else I've been paying attention to just because where wheat's at. Wheat and rice kind of battle back and forth for whichever one is the dominant world feed supply for the most part, food supply for the most part. Right now with the way wheat prices, what are you seeing in translation to that, to rice?
We did a 500-year study on the wheat-rice relationship many years ago and tried to determine what was the modulus of elasticity between these two key ag products that the world really feeds themselves on. Because if one's too expensive, they go to the other one. If the other one's too expensive, they go to the other one. They don't care which one. They just want to go with the one that's cheapest. So there is a relationship. And right now, rice is trading at near historic lows in terms of rice is historically cheap relative to wheat on a 500-year basis. We've rarely ever seen rice ever get much cheaper relative to wheat than it is right now. So it doesn't matter what the balance sheet says. Doesn't matter what the ending stock says. What matters is that rice is the best deal in town for half the world, and they are going, they're going to buy as much of that as they can relative to wheat, and those that have it are going to hoard it. It's just the way rice is. When you have something that's that important, you hoard it, and then people panic buy it. So the rice market, in our view, has no, famous last words, but almost has nowhere to go but up, unless the wheat market were to just suddenly, crash a couple of dollars, which anything's possible, but not likely. Okay. So our view now, how high can rice trade relative to wheat? Typically, it's not unusual for the rice market to trade at 3 times the price of wheat. So if wheat's nice round figure is 8, it can trade at 3 times or 24, 25 versus the 14 and change it is right now. So just giving you an idea that if the rice market were to reprice to the higher end of its modulus of elasticity of price pattern, it could trade at 24 and be on the other side of the value chain. No way anyone can predict it's going to go that high, other than to say if it just goes into the middle of the range, Casey, there's a pretty big move here in the rice market. So thinking out loud, if you're a cash buyer of rice, if you're someone that needs to buy rice, if you're a rice buyer, it's probably the best deal you have ever seen, or one of the best deals you've ever seen relative to wheat. So we would strongly urge those that are on the buy side to lock in that cash. We just don't think that this is, and the market is starting to move, Casey. If you look at a chart, it broke through this 1435 area on the March contract, and that's really a major overhead resistance. Mm-hmm. We're almost ready for some blue sky here. just looking at the chart. I'm not a big chartist, but you could just see we're almost ready to enter the period where rice likes to really move if it gets much higher than it is. So it's beginning to recalibrate the price relative to wheat, and so very interesting commodity. It's unfortunate that it's not as liquid of a market as, say, corn or soybeans or wheat. I mean, it's the open interest is only maybe 10,000 contracts, but nonetheless, it's still a very interesting market, one that we think should do quite well here on a relative performance basis.
Yeah, so I'm looking at the rice chart right now, and I should go ahead and preface this. I really don't. I see some spikes and some valleys, so that's my chart aptitude there. But if you do look at it, back in October, it was trading right around 13.86, and now it's jumped up almost $1, over $1. It's down a little bit today at the open, but that's just some intraday trading. But it's gone very parabolic since right about the the 5th or so of the beginning of the month, the 3rd of the month. He hit the low there at 13.02, and it's just been straight up since. So it's been on tear here.
But it's amazing that this 500-year price has been reliable, Casey, over and over and over. 500 years, when rice gets to this level, somehow the market just knows it's time to buy rice.
Yep.
It's very interesting.
Yep. And if you do take a look at that, back in May of 20, when all of the coronavirus stuff was going on, it did reach a high of right around 2057. So you can see where that is a staple in the diet.
And remember now, next to corn, it's one of the highest cost crops to put in the ground because of the high need for fertilizer, the high need for irrigation. Usually there's a lot of insects that are involved with rice, so it's a very expensive crop to put in the ground. So not only is it undervalued relative to wheat, but on top of it, you have major headwinds of who's going to plant this next year unless the price compensates and says, we're going to put this expensive crop down. Who's going to fund it? Well, they need the price to fund it, and I don't think we're going to plant the acres at this price level. So I don't think it's going to happen. Yep. We need a higher price to do that.
Yep.
So,
all right. Last but not least, something that I pay close attention to just because of where I'm at in the world. Sugar. Right now, sugar is trading at 20 cents. That's a good price for sugar right now. I mean, guys are making some good money there. We've talked about that on the show before as to where things are at, what that looks like, and still waiting to see what happens with some sugarcane markets in Asia and those kind of things when they start to come on. But as you take a look what's there, it's really just been a kind of an upward climb here for sugar over the last course of the month here.
It's stalled. We've really, really stalled. We hit a wall at this 20-cent level. We've talked about this, that we just didn't see a lot of upside from here. The India harvest is now getting underway. It looks like the biggest crop they've ever had. I mean, they're looking at record exports potential coming out of there. Thailand also having a huge rebound in their production. We've talked about this, that there's going to be this big supply coming in. So very, very hard to see why the sugar market needs to go higher than 20 cents with that kind of supply coming in. Remember, even though the very good moisture in Brazil is not going to help the coffee crop because of the tree crop nature, it is going to definitely help the sugar crop. So we're anticipating a big rebound in sugar production when they start cutting in March. And so that'll be a next level of new supply coming in that'll be larger than it was during the drought-stricken year of last year. So once again, it just seems to me that supply is catching up. And, the ethanol story is still there. The ethanol story is still, a strong, it provides a good bid in the market, but it's not enough for, to maintain this market or to push this market higher than 20 cents. We just think we're at the top, and we think there's a reason for the market to come down for a little while. And, that's where we think we're at.
Yep. All right. I told you last but not least, but this is truly it. This is the final, I promise. Natural gas. Okay, so I wanted to bring that up because of you were talking about April natural gas and how you thought there was a move to be made there. As you take a look at natural gas right now, it's still doing what it's doing right now. I think it's opened up here it opened at $4.90. Right now it's at $4.97, so we're up 7 cents from the open. I guess as you take a look what's going on there, it just seems like there's just nothing but upward potential here when you look at what's going on.
Well, remember, when markets move in waves. So we had this big wave on Hurricane Ida that made the market really go. And now we're consolidating. Back down, down, up, down, up, down, up. We're consolidating this very large move. This is healthy. Coffee consolidated after the frost of the summer and spent 3 months consolidating, and then boom, the market has moved, to the highest level since 2014 in recent days. So we think this is healthy action. We think this is the kind of action that kind of recalibrates sentiment, that gets a lot of the short-term, fast money players out of the market, cleans it up, and gets ready for when the winter pattern really kicks in here in December, and we can make the next wave higher. So, if I'm a physical buyer of natural gas, I'm someone that needs natural gas, use these down days that are occurring on a regular basis to lock in your cash natural gas needs through the spring. We think that's the strategy right now. This frenetic trading back in May last through the end of the month, Casey, but we think after that we're going to get a clear trend, a breakout from this pattern, and a clear trend back up again. And of course the April contract is at a major discount, which normally is correct, because normally we reach our lows in storage in March, and then we rebuild in April. That's assuming that we don't worry about running out.
Right.
But if we worry we're running out, or we get close to running out, and it looks like April could be cold and more wintry, and we actually don't rebuild, the market has a very substantial mispricing in that contract. So we think the risk reward wise, there's a value there to be had in the April contract versus the ones that are trading, $1.50 higher than the April contract. We think that's an interesting market month to look at. If we're correct about a late ending winter, that could really be a big surprise later in the winter season. So
right on. Well, good stuff as usual, Shawn. If folks want to reach out to you and get more information about what it is that you're doing at Hackett Financial, what's the best way to do that?
Our website is Hackett, Hackett, advisors.com. Plenty of information on there, Casey, as you know, to get a good feel of what we do with weather, how we analyze agronomy and such forth and so on, to see if how we look at the world in agriculture could be of value to your listeners.
Right on. Well, Shawn, appreciate you being on the podcast, man.
Sounds good, Casey. Love to do it next week again.
Right on, man. I'm Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram. That's where you're going to find the latest editions of the Moving Iron Podcast. Also go to MovingIronLLC.com for all things that are Moving Iron related. So with that, I am Casey Seymour with Shawn Hackett. Let's go with some iron, folks. Out. You want to have a meaningful competitive advantage to help sell more equipment. Whether you represent the sales, parts, or management department of an implement dealership, there's a surprising amount of complexity when it comes to tire, wheel, and track technology. Let Axon worry about that so you can get back to supporting your customers. Axon has leveraged years of experience to create a streamlined process that gives you a proven path to help today's grower and sell more equipment. The roots of their organization go back almost 100 years to the invention of the rubber tractor tire. Supporting agriculture is the number one driver of Axon, from product development through sales and service. To find more or become an Axon dealer, head over to AxonTire.com.
Moving higher in the 21st century. Hard-working people working hard